Good afternoon, everyone. Thank you for coming. Thank you for joining. And we would have Lily, our financial consultant, and she will speak about herself. I can't introduce yourself because you are the expert and to speak about your business and what you do. And as Common Capital, we are FD financial institute, community financial institution, if one of the community lender in the Western Mass. We make loan to small businesses and we provide free business assistance to our borrowers as well. We try to help the community by providing pre-loan technical assistance as well to apply for a loan and to have their loan package together to apply for a common capital loan. And we will continue this support for the life of their loans. So, Lily, take it over.
Okay, can everybody hear me okay? Yes. Okay. All right. So thank you, Emil. First, I'd like to thank Common Capital for having me today. I've been working with Common Capital for several years, and the support that they provide to our small businesses locally is truly amazing, and it's an honor to be here and work with our small businesses. Before we jump in, I have a few housekeeping notes. Like Emil said, the webinar is going to be recorded or is being recorded. And if you would like to have that shared with you, you can contact Common Capital. Um, as I mentioned, I have inserted links into the chat if you would like to follow along on the side because, maybe it's just hard to see. The first link is the actual presentation. The second link are the financial statements that I'm going to be referencing if you wanted to take a closer look at those numbers. If you happen to have your own financial statements, feel free to use those as references as well. We'll be studying the profit and loss, the balance sheet, and the cash flow statement if you have any of your own. And at the end, I will be leaving a bit of time for questions and answers. So if you have them, write them down, hold on to them, and then at the end, I'll give you a chance to ask your personal questions and comments. I like to let people know that I won't be able to answer anything specific to your taxes. Sometimes those things come up, and unfortunately, that's a whole nother class. So we're going to skip over those kind of things. But let's just go ahead and get started with business by the numbers. Okay. So for those of you that don't know me, my name is Liliana Kualapai, and I am the owner of On Point Business Solutions. I'm a business advising, bookkeeping, and financial consulting company. I have been a small business owner for over 30 years. I opened my first business actually at the age of 13. And over the years, I've owned multiple companies, both in retail and service industries. Um, I know firsthand the struggles that small businesses face, the fear that many of them have when it comes to their business numbers. I had them too. I honestly had no idea what I was doing when I first opened my business, or even the second business, to be honest. But I had a mentor who sat me down one day and gave me the education and clarity I needed to overcome that number fear and start using my financial statements to make smart business decisions. And after that, the numbers just became my lifeline for business management. And today I focus on helping fellow business owners like yourselves find that clarity as well. So we all approach finances with different levels of anxiety based on our own history with money and money management. My hope is that we can eliminate some of that fear today. Our goal isn't to make you all experts on financial analysis. Instead, I'd like to compare our level of understanding today as the same as you would find at your annual doctor's appointment. You should be able to look at your physical report and get a general idea of your overall health, whether it's based on blood pressure, cholesterol, those types of things. But you're in no way a medical expert. Well, unless you're here today because you own your own medical practice, which that would be a really horrible example. But for the rest of us, just like our personal health report, we should be able to look at our financial statements and notice those key indicators that give us a basic idea of our business's overall health. So we will begin with an introduction to financial reporting and its importance, followed by detailed examinations of the three most essential financial reports. So we have the profit and loss statement, the balance sheet, and the cash flow statement. We'll then look at some practical techniques for using those reports to make your informed business decisions and evaluate your business's financial health. And as I mentioned at the end, we'll have some dedicated time for questions and answers. All right, so let's begin with a brief overview of what financial reports are, how they're generated, and who uses them, and why they're important. Your financial reports are one of the many tools in your business toolbox. Just like a carpenter would use a variety of tools for different projects, your business has a spectrum of reports that can be utilized for many purposes. The financial reports summarize your company's financial activities, helping you determine your overall health. They provide insight into profitability, your financial position, and your cash flow. And by using your financial reports, you're providing yourself with a key, and all of your stakeholders as well, with crucial information that helps you navigate those big business decisions that you make. So who are these key stakeholders? A variety of people in your business are going to rely on your financial reports. So as you probably have experienced, the financial reports help lenders and creditors decide about your business stability and your credit worthiness. If you have ever applied for a loan, which many of us have, you were probably asked to provide at least a profit and loss and a balance sheet, and in most cases, a cash flow statement. These reports would help them determine if your business has the potential to pay them back, as well as what assets they would be able to collect if you don't pay them back. The investor sector would use your financial reports to decide whether your company is positioned to make profits and whether your company has the potential to be worthwhile investments. The financial reports are important for tax purposes, obviously, but other regulatory agencies also require your reports to determine whether you're operating legally and within the financial standards that your industry dictates. Businesses that are audited and don't have accurate reports are at a higher risk for fines, license suspensions, and in some cases, unfortunately, closure. Your management team and your advisors rely on financial reports to monitor your operations and guide those strategic decisions that will affect the future of your company. And if your company relies on donations, your donors will want to see those reports to illustrate how their monies are being spent and whether your company's financial decisions align with their own values. But most importantly, your financial reports, they exist to help you. Many business owners ignore their financial reports or only generate them because they have to or required to at the end of the year. And commonly they just avoid them because they don't understand the reports and they might find them intimidating. But without using the reports to help you make those strategic decisions, you're essentially just flying blind. My goal today is to help you start operating your business with your eyes set on your financials so you can run your business, as the title suggests, by the numbers. So before we dive into the actual reports, I have to emphasize, and not just because I'm a bookkeeper, but the importance of really good bookkeeping. The financial reports are based solely on the data that you or your bookkeeper input. So whether it be in a bookkeeping platform, let's say Wave or QuickBooks or something like that, or even if you're just using an Excel sheet or some type of manual ledger, if you don't take the time to track your business numbers, those reports that we're going to examine are going to be meaningless because the numbers aren't real. The bookkeeping portion is a class in and of itself. So we won't be discussing the details about bookkeeping, but just keep in mind that the reports we're about to cover today are only useful to you if the books that you're using are updated regularly and managed accurately. All right, so there are three basic primary financial reports. A lot of them have different names in the nonprofit sector. So if your business is a nonprofit, they will be called something slightly different. But the basics are the profit and loss, or the income statement, P&L, statement of activities, the balance sheet, or your statement of financial position, and then the cash flow statement, or the statement of cash flows. So I like to start with the profit and loss, or the P&L. People are most familiar with this report when they're thinking about their financial statements. If you happen to have your own, go ahead and open that up, or you can just follow along with the sample company that I will be using for today. All right, so profit and loss. The first misconception that people usually have with their profit and loss is that profit and loss is equal cash, which they do not. The profit and loss is really just a result of an equation. You're either having more revenue to expenses or more expenses to revenue, and in a specific period of time, the answer to your equation is your profit or your loss. So we're going to have a very basic example here. First, we're going to determine the period of time. Profit and loss is always over a specific period of time. This one will be August 1st through the 31st, for example. In the first scenario, we did $1,000 in revenue in this period of time and only had $400 in expenses, which would make our profit $600. But let's say we did the same amount of sales, but had $1,200 in expenses instead of the $400, which our simple math would leave us at a loss of $200 that month. But when we go forward, you'll see this example doesn't show that we ended the month with $600 or less than $200 in the bank, because those numbers do not equal cash. They're just the difference between the revenue and the expenses and are the result of that equation. So as we move forward, you'll notice that there are many other factors that contribute to the cash that you have in your bank. So this is an example of a fictitious company's profit and loss. I'm going to try and make this a little bit bigger for everybody. Okay. So first, let's look at the report setup. And if anybody's having a problem seeing this, I actually don't have my chat open, but Emil, can you let me know? Okay, so first, the date range. So like I said, all the profit and loss have to have a date range. It's a period of time. So we're going to be looking at this report, which is dated January 1st through June 30th of this year. Now, income is always at the top. You'll see the discounts given is also part of income, but it's as a negative income. So it goes against your income. Next, we have the cost of goods sold. So those are the costs directly associated with either generating or producing the products and services that you sell. So for many of you, it might be ingredients or the materials that you use to produce your goods. And then once you subtract your cost of goods from the income, then you get to your gross profit. And the gross profit is basically everything, like if you were to take home all your money from that point forward and had no expenses, that's where you are. So that's where you start. But again, of course, there's a lot more to explore when you're looking at your expenses. All right, I just lost my spot, so hold on a second. Okay, so are we on the same one? I'm sorry. Hold on just a second. Okay. So the section in the middle here is your expenses. So expenses are all the costs of doing your business. So marketing, interest, rent, travel, insurance. And the gross profit minus the expenses is what you come up with for your net income here. So that would be your net income if nothing else happened in your business. But there are other things that happen. Interest or depreciation would also show up in this area, but they do not affect, they were not affected by your actual business. You didn't have to do any work to get the interest or deduct that depreciation. So those are extra or other incomes and expenses. And once you get rid of those, you end up with your net income, or what we would call the bottom line, which many of you would see as your taxable income. You'll notice this example, the January 1st through June 30th, the income outweighed their expenses. So they had a net income of approximately $22,000. This doesn't mean that they increased their cash by that amount. It's just the calculation of the income and expenses without taking into consideration anything else. So let's see what happens if we expand the period by just 1 month. So now we have January 1st through July 31st. So this is the company's profit and loss, but I've really just changed 1 month. But you can see from the net income at the bottom of the report, it's a very different story. So we've gone from a $22,000 profit to a negative $3,000 loss in 1 month. And so this is an example of how profits and losses can fluctuate dramatically depending on the date range that you choose to report on. And again, I know I keep saying this, but this negative number doesn't reflect the cash in your bank. It doesn't reflect the cash in or out of your bank. It's just the result of the equation of the two numbers of the income and expenses. So there's a lot of other numbers that can attribute to a fluctuation like this. So we're going to examine these two different P&Ls in more detail shortly, just so you can see what might have happened. So how do you use these profit and losses? The report gives us a huge range of information that helps us track our trends or identifies red flags. It helps us determine our pricing. And if you look at your sales, it helps to see the trends. If you look at a report over a period of time and then change those dates like we did previously, you'll see some trends. For example, if you run your profit and loss each month, you'll notice that perhaps January is consistently busy, but February is always slow. We might decide to put that extra money aside that we might have in January to pay February's bills. You could also try increasing sales in February by launching a marketing campaign every year or running a clearance sale to move your old inventory. The profit and loss also helps us determine if our pricing is on target. So if you notice your costs of goods going up, but your sales are staying stagnant, that's a red flag that something needs to change. Perhaps looking for less expensive suppliers or increasing your prices would be a good idea in those times. By regularly monitoring expenses, you'll be able to identify areas of overspending or expenses that are increasing with maybe very little return. So if you launched an expensive marketing campaign, for example, but you notice no significant change in the sales, you might assess how that campaign could have been improved. Or if those sales are low, but payroll is really high, you may want to cut back on hours. At the same time, you may have a goal, for example, in mind that you want your business to donate to charities for a specific amount every year. But then you look at your P&L and you notice that you're spending very little in that area. So you and your stakeholders might decide to cut back on some non-essential expenses so you can adjust and put more money towards those charitable contributions so that you're more in line with your priorities and maybe your donors. So the profit and loss helps you make these types of important decisions, and then you can weigh your options with your stakeholders. So a simplified breakdown of what a profit and loss does show us. If you're looking for your income, expenses, cost of goods, your interest and depreciation, which we'll get to in a minute, and your profit or losses, this is the report that you want to look at. But there's a number of things that it does not show us. You cannot see any account balances on the profit and loss. You can't find loan or credit card payments. You'll see the interest expenses and the interest accumulated on your, say, your credit cards or your loans, but not the principal portions of those payments. So those payments are not actually expenses, which is why they don't show here. They're just money that you're paying back that you borrowed from someone else. You also won't find any large asset purchases on your profit and loss, such as like a big piece of equipment, or if you bought a building or your land, because those are not actually expenses. They added value to your business. And so they're going to depreciate over time as a big asset. And so that depreciation is going to be an expense later, but it's not going, the initial purchase of those big items are not going to appear as an expense that you can write off at the point of purchase. Most importantly, and I know I keep saying it, but hopefully by the end, if you haven't learned anything, you'll learn that profits and losses do not equal cash. And I know I say that a lot, but it's the biggest thing that people have a misconception about when I talk with them about their profit and loss. They think, oh, I've got a profit. Why don't I have any money in the bank? And that's because profit does not mean more cash. So if we don't see all of these things, the bank balances, credit card payments, we don't see any of that on the profit and loss. So where would we find that? So there's two other really important reports to examine. And the first one would be the balance sheet. So the balance sheet gives us a very different perspective of our business's health. If you have your own balance sheet, go ahead and use that to follow. But I'm going to use that same company's balance sheet to give you an example of what that would look like. So unlike the profit and loss, which is that period of time, the balance sheet is just one little snapshot in time. So if you want to know the balance of any of your accounts in your business on one day, this would be the place to look. So if you want a basic idea of what your business is worth, taking into account what you own, like all the assets, taking into account your own investment, like the owner's investment or draw from the business, and what you might owe people for the business, this is the report that would give you those answers. So we're going to look at the report itself, but it's important to know what the three sections are of the report and what they actually mean. So the first section is the assets. Assets are the things that the company owns. So this could be your money in the bank, but it could also be any tangible properties like buildings, land, your inventory if you're retail, your equipment. And if your business also has intangible assets, let's say you have a copyright or some kind of intellectual property or a trademark, those would also be part of your assets and a value to your company. Now, the liabilities are the obligations you have to other people. It's all the debts that you owe. And then the equity is what remains. After you subtract those liabilities and debts from the assets that you own, that's what you're left with. So if you liquidated all of your assets today and then paid off all your debts, equity is what you have. And if you wanted to sell your business that day, that's the number that a lot of people will look at to see how much your business is actually worth. And yes, it could be worth negative. So sometimes those numbers aren't lovely, but this does show you sort of what you're worth at the end of the day. So here is a sample balance sheet. I'm going to try and make this one bigger as well. Okay, so this is our fictitious company. We're looking at one snapshot in time again. So this is the June 30th report. So we're only looking at what this business looks like on that date. If we were to change it, it could be a completely different snapshot. So on that day, at the top, we have our assets. So on this day, the business has about 37,000 in the bank. It has no other assets. Like if somebody owed you some receivables, or they borrowed something from you, that would be another payment that you could deposit. It also has this asset. It looks like this company probably purchased a large piece of machinery. And so that is here sitting as a valuable asset. Again, we don't include those in the profit and loss because they're not actually expenses. So the assets altogether, if you look at the cash that you have in the bank and the assets that you own, this business has just about $64,000 in assets or value. Now we'll look at the liabilities, or the things that the business owes to other entities. So, for example, it looks like this company has some credit card debt. So here we have about $14,000 in credit card debt. They also looks like they owe about 1,600, and potentially that's probably sales tax. They've collected sales tax, they're holding on to it, and they're going to have to pay it back to the state. And then you can tell here, they also have this loan of 22,600. So all of those are things that they don't actually get to keep. They're going to have to pay all of that money back. So if you subtract all of those liabilities from their value, or the assets that they have on hand or in their asset possession, they actually have an equity of 25,000 approximately. So on June 30th, they had 64,000 in assets. They also had 64,000 in, or I'm sorry, 38,000 in debt. And then if you include the net income that they had in their profit and loss, and I won't get into too much, it gets a little accountant heavy here, but just imagine that this is the money that was left over when you had your profit. Then you know how much your business is worth by what's left. So if this business was to sell today just for a straight value, they would get about 25,000 unless they could, bump up the price a little bit. So it might be worthwhile to sell if that's something that they're looking to do. So in the equity, a lot of people will ask, why do the total assets equal the combined liability and equity? Basically, in order to have any kind of assets, they have to be funded somehow. So they're either funded by the liabilities and your debts, or they're funded by investments and equity into the company, or in this case, some of the profits of the company. So that's why they always equal out. And that's why it's called a balance sheet. It not just shows us our balances, but it makes sure that our books are balanced to equal the amount of assets that we have, which is a lot of stuff. Basically, if you just know this report as how much are we worth, then you'll understand this report a lot better than trying to figure out the little details. But that's why this is so important, because it shows us how much we owe and how much we own. Okay, so how do we use this balance sheet? This report would give us information that helps manages the business in the short term and the long term. It ensures that we can cover our debts and determine our company's worth. If the business cannot cover its expenses and debts, it might be necessary to take out a loan or acquire some other type of funding, such as an investor, or maybe an owner's infusion. And this balance sheet helps us determine if that funding is necessary and how much. So the balance sheet is key for funding. It tells us whether the business has enough equity or ownership in the company to make an investment worthwhile or the risk worthwhile. Okay, so just like the other sheets, the balance sheet has things it includes always: bank balances, the value of your assets and investments, your loan balances, all the debt, and then how much your business is worth. It does not include any of those transactional items in and out that the profit and loss showed. So it does not include your income, your expenses, or cost of goods. It doesn't include any of that interest or the depreciation on your loans or your assets, but it does show what's still left in that principal. It won't show the payments to those debts, although the interest is in the sorry, it doesn't show the payments to those debts because that's also in a different report. You'll notice that the payments were not in the balance sheet, but they also were not in the profit and loss. So we're going to get to that in a second. And you're not going to see the initial purchase price of those assets. You'll notice that there's some things here that were both in the profit and loss does not include and the balance sheet does not include. And so it kind of leaves us with where are those things? Where are the loan and credit card payments? Are they expenses? No, because they're just borrowed money. So that's where we go to the cash flow statement. So the cash flow statement, that tracks how the cash enters and exits the business over a period of time. So I actually find that this statement is the most important for many of my business owners when they're looking at their financial management. But it's also the one that they overlook the most frequently. So again, just like the profit and loss, it's over a specific period of time. We look at it, and it's just the money in and money out. So this would include all of your operating expenses, all the things that showed up on that profit and loss because you have income and expenses. But now we're also going to be able to see the loan and the credit card payments because those were cash out. You're also going to see the incoming funding and any of those big asset purchases that you made, which didn't show up anywhere else either. So this statement is completely transactional. It's basically just tells us how much money we start with at the beginning of a period and then how much we have left at the end. So the cash flows are influenced by three types of activities. So we have operating, which are the monies that move through the business for your core operations, basically your sales, your expenses, things that help you every day. The investing activities are the purchases or selling of assets. And then your financing activities are the monies coming into the business from the other funders, but it also includes your repayments to those funders. So here's another example. We're going to use the same company at the same period of time, the January 1st through June 30th. For the cash flow statement, the negative numbers, for example, the tools, machinery, equipment here, these aren't profit and loss. These are just negative cash, like cash leaving the business. The positive numbers is money in, the negative numbers are money out. So the net income from the profit and loss does show up here in the operating activities, which is the same number that we saw in the profit and loss earlier. The other thing that shows up in the quote unquote operating activities are the ones that have been borrowed, what we would call borrowed from a credit card company, or any vendors that covered the cost during this period that you'll have to pay back. So you got the money in this period of time, you're able to use it, so it is money in, and later you're just going to have to pay them back. So later you'll see those numbers come back negative because you paid them out. These were those numbers here that you saw on the balance sheet as liabilities. You'll also notice that big piece of equipment that we saw in the balance sheet. So obviously sometime between January 1st and June 30th, they bought this piece of equipment because that's when the money left the company. If we were to look at a different period of time, we might not see this number here because it might not have been when they purchased it. We also never saw that number again on the profit and loss because, again, it was an asset and not an expense. So the balance sheet would have showed this number like we saw, but as a positive because it added the value to the business. But here it's a negative because it was the cash that we used to spend on that asset. So it's kind of an interlocks, but they look different on the different reports. So we also see that big loan, what we call the penny lender loan, here in the financing activities. That's money in because that was the money that the lender actually deposited into your account sometime between January 1st and June 30th. On the balance sheet, that will show up as a liability because it's a debt, right? All right, so the most important numbers here for our purposes today are the three at the bottom. So the cash flow statement will show us what our beginning cash balance was. So as of the beginning of the period, January 1st, we had $5,600 in the bank. Then over the course of that period of time, we increased our cash. We got a loan, but we also spent some money on that equipment, but we also made a lot in our sales, which left us with a bigger cash balance at the end of this period. So on June 30th, we increased quite a bit in our cash, mostly from the loan and the sales that we made. If we had a negative increase, by the way, if this business did not have a great cash flow month, you might see that you've lost money in that period of time. Fortunately for this little company, they are doing pretty good right now. Okay, so how do we use this statement? A common confusion is that higher income equals more cash. So many businesses know they would feel the pain if their cash was losing, they were losing cash over time, even though their profit and loss statement looked great. There are important figures that the cash flow statement will show us to determine where our cash is going. So for example, if we had a net profit of $10,000 and then we had to buy $7,000 of inventory because we sold so much inventory, and then we also had to pay our debts of $4,000 as our monthly payment, our cash flow was actually negative $1,000. So even though on the profit and loss, we looked great, we were making $10,000 of profit, we actually lost $1,000 in cash flow. So it's really common for a company to be profitable but low on cash, or vice versa, because they may have taken a loan out and then increased their cash that year. So it's a great tool for identifying where's the money going. So many of my clients will ask me, it feels like I'm doing really well, but then I can't pay my debt or I can't pay my electric bill. They're like, how is that possible? I'm selling so much. So we look at the cash flow statement and we say, oh, yeah, well, the cash is going out because you're paying this large debt and you have to replace all the inventory that you purchased and you haven't sold it yet. So it's just sitting there. All right, so back to the what it does and doesn't. The cash flow statement includes all your cash in and out. So if you want to know how much cash you have, this is where you go. The loan and credit card payments, this is the only place you will see those principal payments. The asset purchases, and any funding increases, whether it's you putting money in or an investor or a lender. So it helps to fill in those blanks that the profit and loss and the balance sheet don't show us. But there's many things it also doesn't show us. So it obviously won't show us our income or our expenses. It's not going to show us any balances. It won't show us the value of our business or any of our profitability. It just shows us our cash. Okay, so we crammed 3 courses basically of what these statements mean and look like in less than an hour. So it would be completely unreasonable to expect you to utilize every single piece of this. But there's some key takeaways that I hope you will take away today, and it'll help you manage your business just even a little bit more effectively. So first, please make sure your data is accurate. So your reports are only as useful as the data that you use to produce them. If you haven't already, make sure that you implement some type of bookkeeping system. Some people will use QuickBooks, other people will use Wave, some will use Excel, and if you're really old school, you might just keep a ledger. So something to help you keep that data accurate. If you can't, then it's probably time to try and invest in a professional to help keep you on track. So make sure you just have those systems in place so you can track your finances. And that way you can make sure your numbers are accurate and you could run a report at any moment and see, how is my business doing? So now just keep in mind that all 3 of these reports are important, but the best way to utilize them is by working together. So the profit and loss tracks your income and expenses, showing us if the business is profitable during that specific period of time. Whereas the balance sheet tells us the balance of all of our accounts, tells us the balance of our loans, the assets, helps us determine what our value is. And then the cash flow statement tracks our cash in and out over that specific period of time again. And the best way to determine your business's financial health is to analyze all 3 simultaneously, because if we only focused on one, we're not getting the full picture. All right, so make sure that your reports are not only for tax time or when you need to apply for a loan and you suddenly need to have all these reports. So look at them more like tools that should be used regularly. My opinion, best practice is to run and review your reports at least monthly so that you can spot trends or potential red flags in real time. If you wait too long, you might miss something, and then it might be too late to fix it. It's also helpful to compare your old reports to your new reports. You could do this by just generating a comparison report, which most of your bookkeeping software will do. Or some of my clients will just keep paper copies of all of their reports and then just kind of lay them out and see what the trends are. I also suggest at least quarterly reviews with some type of professional. It doesn't have to mean paying for an accountant to come in and look at your statements, but organizations like Common Capital, or if you have a business advisor, anyone that can give you sort of professional insights into your business health will really help you plan for the future of your company. Okay, that's it. So I'm going to stop sharing my screen real quick. If you have questions, I'm going to try to get to everybody. If you have questions, go ahead and use that raise hand reaction button at the bottom, and we'll try to get through as many as possible.
Thank you, Lily. That's very, very informative. A lot of information, but I'm sure it is very useful.
I hope so.
Janelle has a question. Go ahead.
Yes, thank you, Emil. Thank you, Common Capital, and thank you, Liliana. My question is, as a small but growing service-based company that handles multiple revenue streams such as courier, mobile drug screening, and also mobile notary public services, what is the best way to structure my P&L so I can clearly see which service line is most profitable month to month?
That is a great question. And the fact that you're even thinking about that means that you've already kind of got an idea of what you're looking for and what stories you want to see from your reports. The best thing that I always find is that you actually have your income line at the profit and loss, the top, but you also set up your chart of accounts to have sub income lines. So you have like the big income line that if you just wanted to see how much you made total, you would see that. But underneath that are all the things that came into it. So you might have courier, you might have, for some people, it might be just Square or any other things. I have a client who has in-person services, online services, and they like to see which one's doing better. So they set it up as a sub account of their income. So they have the choice. They could run the full report and just see the total, or they could compare that one line of, let's say, the online sales over the course of time. So you can see both. So sub accounts are really useful for that. Yes, that's it. Yes, big income line with subcategories. Are there any others?
Hi, Lily. Liliana.
I know you.
You know me. I was going to ask you, so you know how I keep my Excel spreadsheet, and then I
Yep.
have a bookkeeper and an accountant, so I'm
Yep.
good. But I'm wondering if I can use my Excel spreadsheet, if I can tell in Word it's Copilot, if I can ask it to kind of like analyze the stuff, and how would I do that? What would I ask it?
So like an AI, tell me how
Yeah.
I'm doing. Um, it's a little tricky because yes, as long as the Excel sheet is set up correctly, and all the things are labeled in the same way, AI should be able to at least give you line by line comparisons.
Mm-hmm.
So Copilot's pretty good at doing that. It's always good to sort of ask a professional. And what I would do actually in your situation, and this might be helpful for most of you, if you have a bookkeeper, um, they have access to your reports.
Mm-hmm.
And so I find that it's really important for you to ask your bookkeeper for monthly statements,
Okay.
and be really proactive in talking to them about what you're looking for. So, for
Mm-hmm.
example, I would provide someone, their generic profit and loss and balance sheet and cash flow. But one of them said to me, I'd really like to know this specific line and how I'm doing. And the bookkeeper can do that for you and just print out that. You can say, how much am I spending in my kitchen staffing, right? Not just
Mm-hmm.
staff. She wanted specifically to know her kitchen staff.
Right.
So we set up subcategories, and that's how we figured it out. So yes, AI is amazing. But I always find I have to double check, right?
Okay.
Because
Yeah.
it's only amazing until it's not. So I would definitely trust you pay your people, bookkeepers and accountants get paid, so you should use them, and that's what
Right.
they're there for. Yeah.
All right. Thank you. Thank you so
You're
much. And it's
welcome.
you. And thank you for doing this, and Common Capital for doing this.
I think I see a question here. It says, when applying for business lines of credit or government contracts, which financial report do lenders or contracting officers care about most? And how can I make sure mine looks strong and professional? Okay, that's a lot. In my experience, they want them all, because, like I said, they tell a different story. Um, uh, let's say we'll just use Common Capital for an example. If you've applied for a loan with Common Capital, I'm assuming, because I've seen a lot of them, you're definitely going to need a cash flow projection. They want to see what is the expected cash balance at the end of if they do all these things with our loan, are they going to have money left over? But they also want to know, are you going to be profitable if you make all those decisions? And what are you going to have at the end of the day? And so really it's all three. Now, how to make them look strong and professional, most people need some help, to be quite honest. And fortunately, a lot of lenders, especially in the nonprofit world, will have people to help. Or you can go to a local small business, center to help, to make sure they look strong and professional. If you're not in business yet because you're a startup and you don't have a bookkeeping service or a system in place, do your best to find, even if it's a template online, to make sure that it looks good, right? And then have somebody make sure it makes sense. But yeah, most of the lenders, especially like Common Capital and some of our, uh, community lenders, are there to help.
And we at Common Capital, we provide the pre-loan technical assistance right now. We have Kelly Thaddeson. She's the person who help the client to put together the financial projection, which is we use a template. We have a platform, Initiate. We have a very detailed financial projections, and it's a good tool. Even there is an educational piece with this program, and we help the client who come to Common Capital and provide those assistance if they are coming to Common Capital. And sometimes we just help them, and if they want to decide to go with our funding or somewhere else.
And it's a great exercise because if you're not sure, especially if you're a startup and you're not sure whether your idea has merit or if you've thought through all of it, usually you kind of make some discoveries along the way, and it helps to maybe focus in on where are your weaknesses and where are your strengths.
A question, Lily, if let's say the profit and loss doesn't show the full picture if you are profitable or not, maybe the cash flow will show more. Which one of those tools can tell the business owner where they are, if they are profitable, how much their profit, and at what time they can see this, by the end of the year, in certain time?
So I guess the difference would be if you're profitable, right, that has tax implications and the ability to keep staying in business, right? So being profitable means that you're basically selling more than you're spending, right? But like I said, that doesn't tell us whether we have money in the bank. We don't know if we can actually replace the inventory or pay our people. So if you use them together at a specific moment in time, let's say you decide every quarter, I want to assess this, right? Because every quarter you might see lots of trends and dips. If you look and you say, I'm very profitable, sales were great, we got Black Friday, we did all this stuff in the fourth quarter, but I have very little cash in the bank. It's probably because you spent a lot of that profit or you had to take out some kind of debt to make that profit. So you might think, oh, maybe I should save some of that before I spend all of it. Does that make sense? So you really, using them together makes such a huge difference, because I know if I, like on, let's say, a personal, side, I can buy all my Christmas presents, I put them all on my credit card, I got my mileage and stuff, but January hurts a little bit because now you have to pay it back. So keeping track of all that is really important. And when we do analysis, like I said, I wouldn't expect non-finance, accountants. You don't want to have to sit there and look at every number, but if you can pick key indicators, if you want to keep track of one thing that you're like, I can tell if I'm doing this really well, I think I'm good. Or if you have a goal, I want to have X amount of money in the bank, at the end of every quarter so I can pay taxes. Whatever it is, you can find that answer somewhere in your books. I don't
Thank
think
you,
I
Lily.
see any more
And
in
if
the
there's any
chat.
questions? And do you feel, Lily, investing in any kind of accounting software, QuickBook, Wave, Zeros, and any one of those, is it a good investment, or keep doing the Excel sheet and the paper? And
So personally, I think that having that robust system is really helpful. the accounting software, the bookkeeping softwares that are out there are so intuitive that you don't have to work too hard with them. I mean, once you learn how to use them, then you're able to sort of manually or even automatically have things go in, and then you can just hit a button. Whereas if you're in Excel, you have to set it up. First of all, you have to make sure it's right. You have to make sure that you have all the formulas set up. It's really hard to run a report though. Like setting up a profit and loss report isn't as bad, but setting up a balance sheet and a cash flow statement in Excel is very tricky. So I guess the answer is yes.
Thank you.
You know, QuickBooks is the more expensive, and it's one of those, you know, you pay subscription. So even though it's one of the most robust, it is one of the most expensive. Wave is an alternative that isn't. And it might be good to start there, and you can always upgrade.
Thank you, Lily.
Mm-hmm.
Okay, I will stop recording.